Multi-asset funds. Multi-asset funds, as the name suggests, are funds having multiple asset classes as equities, commodities, and fixed income instruments in the portfolio to give diversification benefit. They add value as each asset class behaves in its own fashion. For example, equity and gold move up and down in cycles, whereas debt gives stable returns ranging between 6 to 8%. Gold, being safe haven, has inverse correlation with equities. These instruments make meaningful sense collectively as each asset class behaves in its own fashion and are less affected by each other's movement. Gold, which is driven by demand and supply, presently looks promising at the backdrop of Fed interest rate cuts expected in this calendar year. We all know Indian household has special love towards gold, but internationally also 16% of government assets are in gold. If we talk about Indian economy has the right ingredients in place to set the momentum further with factors such as improving infrastructure, manufacturing, the China plus one strategy, that is curtailing imports and stepping up exports, formalization of economy, demographics, and rising digitalization. All these factors will add to improve corporate profitability, which in turn means growth for Indian equities in long run. Though the journey of equity market will be volatile due to elections, global news, global growth, inflation, monetary policy of major economies and of India also. Interesting fact is that whenever equity market has given negative returns, 90% times gold has given positive returns. Not saying that when equity gives positive returns, gold will give negative returns. So diversification across asset classes help in return optimization and reduce risk. Just to give you in perspective, I'll share you some data. Rolling 3-year returns of last 13 years starting from January 2010 to September 2013, the average return of Indian equity market is 11%, whereas the best has been 30% and the worst has been 6% around. Similarly for gold, it has been 25% on the best class and worst is 8%. But if we mix both of them, the combined portfolio, the best returns has been 18%, but the worst has been still positive 2.2%. That is what the power of a multi-asset portfolio is. Similarly, rolling returns in 5 years, average is 11% for equities, average is 8% for gold, but for multi-asset portfolio, it's 9.5%. That's the reason a multi-asset portfolio is able to sail through without giving much of volatility in the overall portfolio. Sundaram Multi-Asset Allocation Fund is approved by HDFC Research. Our research approved fund basis evaluating the company which is managing the fund via corporate governance, how they are good in risk management framework and what kind of AUM they manage. We also evaluate the investment team, the brain behind the operations, their reputation, their historical success and failures, and what they have learned out of it. We also track performance metrics, not just point to point, but on the stability point of view, consistency and over multiple time frames. Lastly, the alpha which they create over and above the benchmark. A new fund, which is in this context we are talking about Sundaram Multi-Asset Fund, creates a fresh portfolio looking at the present opportunities starting now. And being a multi-asset, there is a flexibility to move across asset classes as per the fund manager's view. In this current scenario, moving between various asset classes definitely have impact of cost, timing and taxes for an individual. But in a fund of a multi-asset, the same is done within the fund, and for an investor, it's an equity taxation, since the equity allocation throughout the fund is 65%. The fund is available from 5th of January till 19th of January. Please read entire documents carefully. Mutual funds are subject to market risk, so kindly understand your risk before investing. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.